As of the close of the regular trading session on Tuesday, July 9, 2026 at 4 p.m. Eastern Time, the United States stock market is closed, and Navitas Semiconductor stands at an exact closing price of $14.18 per share. This represents a substantial intraday upward movement of 6.14%, gaining 82 cents from the previous session's close of $13.36. Throughout the day, the equity demonstrated significant price discovery, hitting an intraday high of $14.53 after opening the morning at $14.06, while finding solid support at an intraday low of $13.84. While the headline numbers show a healthy rebound, the real insight that caught the market completely off guard this week lies beneath the surface of a major legal conflict. Just 24 hours before this rally, a massive patent infringement lawsuit was filed by Navitas by its chief rival, Wolfspeed. Typically, a structural legal threat from an entrenched competitor sends a small semiconductor player into a multi-day downward spiral as conservative retail traders flee on platforms like the Robinhood app or via basic online investing accounts. Instead, institutional aggregators and sophisticated market participants stepped in on Thursday to aggressively absorb the selling pressure, recognizing that Navitas has secured an infrastructure integration that the legal noise cannot easily displace. The expectation was a devastating, prolonged sell-off, but the reality is an aggressive accumulation phase by entities recognizing the structural necessity of next-generation power materials. To understand why this divergence between expectation and reality matters, one must examine the broader sentiment surrounding specialized silicon. For the average individual managing a self-investing strategy, small-cap chip design firms are often viewed as highly speculative lottery tickets, far removed from the stable balance sheets of mega-cap giants like Apple stock or the relentless momentum of NVIDIA stock. Many investors assume that small component suppliers are entirely at the mercy of industry cyclicality and supply chain gluts. The contrarian reality, however, is that as platforms like Tesla stock expand their computational networks and next-generation artificial intelligence hardware scales out, power delivery is becoming the absolute bottleneck of global technology. Navitas does not just build generic components, they design the specialized wide-band gap semiconductors that prevent modern data centers from melting down under intense electrical loads. Looking closely at the recent price action, the daily swings tell a fascinating story of institutional positioning versus retail anxiety. When the news of the Wolfspeed lawsuit broke on July 8th, the stock experienced an immediate 6.4% morning drop, flushing out short-term traders who leverage basic Robinhood stock trading or standard online investment sites for quick momentum plays. Yet when you look at the trading volume data for July 9th, approximately 15.6 million shares changed hands, which is actually below the 90-day average session volume of over 28 million shares. This lower volume rally indicates a lack of aggressive selling conviction. The weak hands were completely shaken out during the initial panic, allowing the price to snap back swiftly as buyers used platforms like Interactive Brokers Trading and Fidelity Brokerage Systems to accumulate shares at what they perceived as a temporary discount. This price stability highlights a significant shift in institutional ownership over the past few months. Heavyweight asset managers such as Vanguard Group and State Street have been quietly lifting their stakes, absorbing a meaningful percentage of the free float. When multi-billion-dollar entities increase their positions in a volatile asset, they are looking past immediate quarterly turbulence and focusing on long-term hardware architectures. Traders managing their own individual brokerage portfolios through the SoFi trading platform or utilizing sophisticated interactive brokers platform tools are increasingly finding themselves competing with these massive funds for a limited supply of shares. This institutional backstop is precisely why the stock refused to break below its key 200-day moving average during the height of this week's panic. At the core of the business model, Navitas operates as a pure-play pioneer in gallium nitride and silicon carbide power semiconductors. Unlike traditional silicon components that lose efficiency and generate immense heat at high frequencies, these advanced materials allow power systems to run faster, cooler, and with vastly reduced physical footprints. Navitas has methodically transitioned away from its historic reliance on mobile phone fast chargers, which are low-margin retail products, shifting focus towards high-power infrastructure. This includes designing massive 20-kilowatt power delivery boards optimized specifically for advanced artificial intelligence data center architectures, a development highlighted during recent technical collaborations within the broader hardware ecosystem. By solving the direct conversion issues from high-voltage grids straight to the silicon core, they are embedding their intellectual property into the very foundation of modern cloud infrastructure. Financially, the company is managing a high-stakes transition that requires careful navigation of cash burn and revenue cycles. In their last official quarterly financial disclosure from May 2026, Navitas reported total revenue of $8.6 million, showing solid sequential growth of 18% compared to the prior quarter, though still down on a year-over-year basis. Crucially, they managed to beat conservative consensus analyst estimates by posting a smaller-than-expected loss of 4 cents per share. The management group maintains a clean balance sheet with over $221 million in cash and equivalents and carries a highly favorable position of holding more cash than total debt. Investors are now laser-focused on the upcoming second quarter financial results, scheduled for release on Monday, July 27, 2026, after the market close, where management has guided for net revenues to increase to approximately $10 million. Please comment below with how many shares of Navitas Semiconductor you currently hold in your portfolio, and let me know if you think the recent legal challenges from competitors will impact your long-term investment thesis. When we look towards the future outlook, macroeconomic conditions will play an equally vital role as technical execution. High-growth, pre-profit technology companies are notoriously sensitive to interest rate policy and credit market liquidity. For automated asset allocation systems like Schwab Intelligent Portfolios or robo-advisors hosted on the SoFi robo-advisor platform, small-cap semiconductor innovators are frequently categorized as high-beta assets, meaning they experience outsized movements relative to the broader market. If inflationary pressures ease and macroeconomic liquidity improve, capital naturally rotates out of overextended megacaps and floods into compressed small caps with massive technical upside. Conversely, any unexpected tightening of corporate capital expenditures across the enterprise cloud sector could cause a temporary freeze in hardware orders, testing the patience of self-directed investors utilizing any popular investing sites. The structural tension between expectation and reality will continue to define this equity over the next 12 months. The market's current expectation, reflected in its mixed consensus hold rating and conservative analyst price targets, is that Navitas will face prolonged margin compression due to intense legal costs and competitive pricing pressures from entrenched silicon legacy giants. The reality, however, is that their technology addresses a critical physical limitation of modern computing. As data centers demand unprecedented amounts of power to run complex models, traditional power management systems are simply incapable of scaling. Navitas has positioned its proprietary gallium nitride and silicon carbide technology directly at the intersection of this infrastructure crisis, creating a compelling risk-to-reward profile for patient capital. To summarize the central insights of this market analysis, Navitas Semiconductor is currently navigating a classic divergence between short-term sentiment noise and long-term industrial adoption. The intraday rally to $14.18 demonstrates that the marketplace is beginning to look past immediate litigation anxieties and focus heavily on the structural revenue potential of the high-power data center shift. While retail platforms like Robinhood Crypto and generic retail trading portals often amplify daily emotional volatility, the underlying accumulation by major institutional players suggests a deeper confidence in the company's asset-backed survival and technical relevance. Navitas remains a high-conviction, specialized infrastructure play whose ultimate valuation will be determined by its ability to execute on its revenue guidance and secure its place within the global power grid architecture.